Ever wondered why we're all so obsessed with a three-digit number? That's right, I'm talking about your credit score. We're told it's the key to getting a car, a house, even a good deal on a phone plan. But have you ever stopped to ask who this whole system was really designed for? Spoiler alert, it probably wasn't you. Let's rewind a bit. Before credit scores, getting a loan was personal. You'd go to your local bank, maybe talk to a loan officer who knew your family or your boss. Your approval was based on their judgment, which was often subjective and, let's be honest, pretty biased. Lenders needed a better, faster, and more consistent way to decide who was a good bet and who was a bad one. They needed to scale up their business, lending to millions of people, not just the folks in their neighborhood. This is where the modern credit scoring system comes in. In the late 1950s, a company called Fair, Isaac & Company, you probably know them as FICO, developed the first algorithm-based credit score. Their goal wasn't to create a fair system for consumers. It was to create a predictable system for lenders. They wanted to turn the messy art of lending into a cold, hard science. By analyzing tons of data, they could predict with surprising accuracy who was likely to pay back a loan and who would default. So, how does this actually work? The FICO score, and others like it, looks at 5 main things: your payment history, how much you owe, the length of your credit history, the types of credit you use, and any new credit you've recently opened. It crunches all this data into a single number. For banks and credit card companies, this is a game changer. Instead of spending hours manually reviewing each application, they can just plug in a number and get an instant yes or no. It's efficient, it's automated, and it allows them to make millions of lending decisions a day. This automation is what allows the entire consumer credit industry to exist at the scale it does today. Think about it. Instant credit card approvals online, car loans sorted out in minutes at the dealership. None of that would be possible without a standardized way to measure risk. The credit score is the engine of consumer finance. It tells lenders not just whether to lend you money, but also how much to charge you for it. A high score means you're a low risk, so you get a low interest rate. A low score means you're a higher risk, and you'll pay more for the privilege of borrowing. This is called risk-based pricing, and it's how lenders maximize their profits. They can make money off both the safe borrowers and the risky ones just by adjusting the price. Now, here's where it gets really interesting. The system isn't just a passive observer of your financial behavior, it actively shapes it. The rules of the credit score game encourage habits that are fantastic for lenders. Think about it. Why does carrying a small balance sometimes seem better than having no credit card activity at all? Because it shows you're an active and potentially profitable customer. Why are you told not to close old credit card accounts even if you don't use them? Because a longer credit history makes your borrowing patterns more predictable for lenders. You're encouraged to use different types of credit like credit cards, installment loans, and mortgage because it gives them more data points to analyze your behavior. Every move you make to build your credit is essentially you learning to be the ideal customer for a bank. You're demonstrating that you're a reliable, predictable borrower who will consistently use credit and, most importantly, pay it back with interest. The system rewards you for playing this game. A good score can open doors to opportunities that might otherwise be out of reach. It can be the difference between getting a mortgage with a great rate or being stuck renting. In this sense, it can be a tool for financial mobility. But there's a dark side. For those who stumble, maybe due to a medical emergency, a job loss, or just a few mistakes, the system can be a trap. A low score triggers high interest rates, which makes it much harder to pay off debt. This can create a downward spiral. You take on high-interest debt to cover an emergency, the payments become unmanageable, your score drops further, and your only option for more credit is from even more expensive, predatory lenders. You're trapped in a cycle of debt that's incredibly difficult to escape, all while the lenders are still profiting from your high-interest payments. The system is designed to sort people into neat little boxes of risk. And while it removes some of the old personal biases, it has introduced new algorithmic ones. Factors that correlate with race and income can indirectly influence scores, perpetuating existing inequalities. For example, if you live in a neighborhood with less access to traditional banking, you might be more likely to use high-cost alternative financial services, which can negatively impact your credit. The system isn't designed to understand your personal story or circumstances. It only understands the data it's fed. So, who do credit scores really benefit? Overwhelmingly, they benefit the lenders. They give banks, credit card companies, and other financial institutions a powerful tool to manage risk, automate decisions, and maximize profits on a massive scale. They have created a world where access to money and the cost of that money is determined by a number. This gives lenders enormous power to decide who gets to participate in the economy and on what terms. For us, the consumers, the credit score is a tool we have to learn to manage. It's the price of admission to the modern financial world. Understanding that it was built for lenders, not for us, is the first step. It allows us to see the system for what it is, a game with a specific set of rules. And by understanding those rules, we can navigate it more effectively, use it to our advantage when we can, and be aware of the pitfalls. It's not about loving the system. It's about knowing how to play the game so it doesn't play you. Thanks for watching. If you found this helpful, be sure to like this video and subscribe for more insights into how money really works. See you next time.